Hey guys, if you're studying for your life insurance and annuities test, then you definitely want to pass it. You want to pay attention for the next 30 minutes. I'm going to give you a hack for you to be able to make sure that you understand 40% of the test in 30 minutes. That's bananas. I know myself, I studied for a couple of months and I wish I would have had this hack in 30 minutes. That being said, let's get into it. So there's three different types of life insurance policies. We're going to get right into it. The first thing that you need to know is that life insurance is an actual transfer of risk. And the way that it works is that I am transferring my financial responsibility to my family. Okay. So if something needs to happen to me, I want to make sure that I'm passing that financial responsibility, not to my family, but to the insurance company. And it's not like the insurance company is going to pay my bills, but they're going to give my family money, right? My beneficiary money in order for them to have the money for them to take care of the bills for whatever time I calculated. So that is the literal definition of life insurance. It is a transfer of risk. By the way, it's the definition of insurance in general. It's a transfer of risk. Now, there's three main types of life insurance policy, and I'm going to give you the easiest, fastest way that you're going to be able to understand this. It's super simple, and you want to make sure that you watch this video a couple of times. We've done this in Spanish already, and I have people that watch the video 20 times. And they commit this little square to memory. The way that I processed it, the way that I try to understand this was, hey, let me understand what the question on the test is asking. Let me explain to you what I mean by this. Well, sometimes the question on the test is connected to the way that the premium in the policy behaves, okay? So if you're talking about the three main types of policies, by the way, there's a couple more, but this is the three main types. If you want to get more content, all of the other policies and all of that stuff, you can definitely check out the link in the description on our bio, and you will be able to see all of the content that we have. We have a full-on course that's going to give you in a couple hours what you need to know in order for you to pass 90% of the test. But for the types of policies, the next 30 minutes, the premium on the three main types of policies is the following. It's either term, whole life, or universal. And the premium on a term policy is usually fixed or level. The same thing in a whole life policy. What does that mean? Well, both of these policies, the premium that starts is gonna stay the same up until the end of the policy. And we'll talk about the end of the policy in a second, but again, and the question in the test is asking about the premium, then you know immediately, well, if they're talking about the premium never changes, then you know they're either talking about term policy or whole life policy. And now when they're talking about universal, or they're asking about universal, the trend that you're going to see with universal is that everything is flexible. I tell people universal policy is like leggings, okay? Because leggings, it doesn't matter if you gain weight, if you get too skinny, if you had Thanksgiving dinner, or if you went on a diet and you fasted for 45 days, you're still going to be able to fit in the same pair of leggings, all right? Now let's go to the next question. What's the next question? Well, when does the coverage expire? And so if they're talking about the coverage finishes, and I want you to make a big note somewhere, a circle, a star, there's a difference between the coverage finishing and there's a difference between the premium finishing. And we'll talk about the premium in a second. Let's focus on the coverage. When the coverage expires in a term policy, it expires during the term. And you're like, Lorena, that's very simple. Yes, it's simple here because we're talking about this single term. The idea is for you to be able to identify that they're telling you this in the question. So let's go. The term, what do we mean? Well, if it's a 10-year term, guess what? The coverage expires after 10 years. If it's a 15-year term, when does the coverage expire? 15 years. You're right. 30-year, it expires in 30 years. You get it, right? The next policy is the whole life. So guess what? In the whole life policy, the coverage is permanent. Coverage does not expire. It actually endows. And endowment basically means that it pays. This policy endows at age 100. What they're saying is, and this you continue with the policy and you use it and you keep it up until your age 100. At age 100, you're going to have a big birthday party. You're going to have cake. You're going to blow the candles. If you had dentures, the dentures are going to fall off. Okay. And you're going to get a check for whatever the coverage amount is. So if I have a $500,000 policy and I am on my 100th birthday, I blow my candle And then guess what? I'm going to get a $500,000 check. All right. So now what happens in universal? Well, in the universal policy, the policy is permanent until age 120, 121. Very rarely will they ask about 120 or 121, but it's definitely a coverage that is permanent. Now, you're going to see this terminology, and you may want to write it in the corner where it says annual renewable term. A universal policy is technically an annual renewable term policy. Just kind of keep that in the back of your head. It's going to show up on your test. All right. So now next, know how the premium works in all of the policies. We know when the coverage expires in all of the policies. Let's move on to the next one, which is how does the face amount work? Does it go up? Does it go down? Is it flexible? What is it? So in a term policy, guess what? There's 3 different types. The first one is level. You're going to see this trend. Level means it does not change. So if I started a 10-year term policy for 10 years, this policy will not change in the coverage. So if I started at 100,000, it's going to finish 100,000. If I started at 200,000, it's going to finish at 200,000. Now, when it says increasing, the coverage is going to increase. The premium, though, fixed or level, if I was paying $50, it's going to be $50. If it's 70, it's going to be 70. The only thing that increases is the coverage. If I started at 200,000, maybe next year is going to be 205, and the year after that, 210, and the next year after that, you get the point. Okay. So that's what increasing means. The only thing that increases is the coverage, not the premium, and definitely not the term of the policy. If it's a 30-year term, this is going to increase for 30 years. A lot of people ask, hey, how do I know? Right? It's like, when would you use that? Well, if you know that in the future, you're going to have more responsibilities, like, for example, you're trying to have a kid, or you know that you're going to buy a house in the future or something along those lines, you want to make sure that you have an insurance policy so that you can transfer the risk. Remember, right? So that you can transfer the risk, but the responsibility and the insurance grow with you. All right? So now let's talk about decreasing. Just like the name says it goes down. So, okay, a decreasing term policy, same thing. The premium stays level. The term is whatever the term they said. And decreasing means if I started at 300,000, it's going to go down, 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 sometimes all the way down to 0. Most of the times, you're going to see it on the test as credit life policy. And what they mean with the credit life policy is they're saying, hey, if you have a mortgage and the mortgage company says, hey, I want to make sure that you have life insurance. In addition to homeowners insurance, I want to make sure that you have life insurance to back up the mortgage. Well, usually when you're paying your mortgage, the amount of the mortgage goes down. You don't want to have a level policy because imagine if you started with a $300,000 mortgage, many years, you only owe 100,000, but because the policy was term and it was level, it's still 300,000. So when the person passes away, the mortgage company gets 300,000, but you only owe 100,000. That's not fair, right? So I don't know if it's fair, but would you want that to happen? You're like, maybe I want that to happen if it went to my family, but if it only can go to the mortgage company, I need coverage that adjusts with my responsibility. That's what decreasing term does, okay? If my mortgage is here and my life insurance is here and it's decreasing, so it's like 300,000, 200,000, 150,000, 50,000, 0. Yay, you pay your mortgage, okay? So just know that you're going to see decreasing term or credit life. They basically mean the same thing. Not mistake credit life for loans. Loans is a completely different thing. If you want more details, you can check out the link in the description so that you're able to see the rest of the content where we're explaining how loans work and all that stuff for you to pass your test. Now, the next thing that you want to keep in mind is in the whole life policy, the face amount is level. Okay? However, there is one exception, and it is whole life. And in a whole life policy, I have that exception. In a whole life policy, I have the adjustable whole life exception. And so what does that mean? Adjustable, I tell people, If universal life is like leggings, which means they will mold to whatever your need is, whatever your size is, and adjustable whole life policies is like a belt, okay? That, yes, you can adjust it, but you have to adjust it, meaning you manually have to do a change and you change it constantly. Or if you make the change in one end, it's gonna change the size of the belt. Okay. Now, what's the difference between that and level, right? Adjustable is a belt. Level is kind of like it's fixed, like you're stuck with it. The size will not change. So again, level size doesn't change. Adjustable is kind of like a belt. I can go a couple of loops up or a couple of loops down depending on the season, right? The time of the year. And then universal is like a legging. It doesn't matter what happens, it will always be flexible with it. So again, in a whole life policy, the coverage will be level, except if they're talking about adjustable. Now, in the universal life policy, you're going to see this word flexible. And flexible, the difference between the adjustable in whole life and the flexible in universal, and this is going to be super important. You may want to watch this part a couple of times. The flexible policy, if I change the premium, if I change the coverage, don't affect each other. Meaning, if $500 for a policy and my coverage is, I don't know, $1 million, and I want to increase payment on a universal life policy, I can increase the payment to $1,000 and my coverage will still be $1 million. Or I can decrease the payment to $200 instead of $500 and the coverage could still be $1 million. Now, with the whole life policy, and this is where the example of the belt is going to make sense, is that if I adjust if I have, same example, right? $500 for $1 million coverage, it go down to $300, then my coverage amount will also go down for a portion. Okay. So whenever I adjust one thing in a whole life policy, everything gets adjusted. The difference between that and flexible is that in flexible, I could just adjust up and down the coverage or up and down the payment, right? The premium. And it's not gonna, they have a separate relationship from one and the other. I hope that that's helpful. I know that that was super, super, super confusing for me. So it's okay if you have to watch this a couple of times. And by the way, if you like to have this guide, if so far it's been helpful, make sure that in the comments, we're going to have a link for you to be able to download this and you have it. You're going to have the PDF for this thing in there. So let's go for the next thing. How long do I pay the policy? That's the next question. Sometimes on the test, the question that they're going to be asking you is not going to be connected to when do I pay or how much is going to be my payment or how long I'm going to have coverage. Sometimes the question is, how long do I pay the policy? Okay. And this is super important to understand. That's why it's even different colors, right? When does the coverage expire? Meaning, how long is the coverage? Is completely different than how long do I pay for the coverage? And I want you to like break your brain and kind of have it into separate parts. Just because in the test, they're going to ask you a combination of these questions and you really have to know how to figure out the difference. So let's go for it. See, if the term is for 10 years, guess how long I got to pay? Years. That's it. It doesn't, if it's 20 years, I pay for 20 years. If it's increasing, decreasing level, it doesn't matter. It's like literally like car insurance. Okay. You pay for as long as you have it. If it's like renting, you pay for as long as you want to live in that house. If you don't want to live in that house or in that condo or apartment or whatever it is, right? And you're renting, then you go to another place and you pay for rent over there and you pay forever. If it's 10 years, it's 10 years. Now, in the whole life policy, there's like a whole bunch of different ones, okay? So just know that every one of them that I'm going to go through is a different type of whole life policy. The first one is straight whole life. And by the way, you're going to see straight whole life or you may see straight life. Unlike me, I don't do the straight life. Okay. So the straight life, what it means is that the client is going to pay until their age 100. So remember that this policy endows until you're 100. Well, guess what? You're going to pay this policy. If you choose the straight life policy, you're going to pay this policy up until you're 100 years old. You pay, and then it endows and you have your birth. Okay. Now, the second type of policy is limited pay. And so keep this in mind. Put like a little star to it, underwrite it, underline it, whatever it is that you need to do for you to remember that is limited pay. Limited pay, not limited coverage. Limited pay. And so when they're talking about limited pay, they're saying, well, it's a 20 pay life or a life paid up until 65, life paid up until 70, whatever it is. And what that means is I'm paying either for 20 years or up until I'm a certain age. So if I'm paying for 15 years or 20 years, then I'm paying for a 15-year pay or a 20-year pay or a 30-year pay. I pay for 30 years, but that's my coverage. Is until again, your coverage is until 100. So only the payment is for a small period of time in a limited pay life, but the coverage is going to be permanent. Okay. Same thing. If you see paid up until age 70 or paid up until age 80, that means that person's going to stop paying at age 80, but the coverage is going to be until what age again? You're right. 100. Okay. Now, single premium. Single, right? All the single ladies? No, I'm just kidding. All the single premiums, we call it. And the single premium is a one-time payment. You had $10,000 and you're like, hey, it's $10,000. Give me insurance. Okay. And so they say, well, your $10,000 can buy you, I don't know, $50,000 of insurance forever. You pay one time and that was it. That's single premium. All the single premiums. You don't want to hear me say it, but you'll get it. Okay. Now, the next one is modify whole life. And sometimes you're going to see it as graded. It's kind of like the same thing. Modify whole life is in the test, you're going to see that the premium goes up once. That's the difference between flexible, adjustable, and modify whole life. And I want you to keep this in mind. In insurance, there's going to be some concepts and some words specifically that mean something in real life. But in insurance life, they mean something completely different. Or maybe not different, but very specific. That's the example here in modify whole life. So in modify whole life, it does not mean that you can modify it. If you want to modify something, it's adjustable. Anytime you see modify whole life, they're talking about this one particular policy. And it is that the premium goes up once on the policy. Years. Most of the times you're going to see 5 years. So modify whole life, the premium is going to go up 5 years and then it's going to stay the same. So if in the test you see a question that says, hey, so-and-so is going to be paying $400 for a whole life policy, and then in 5 years, they're going to start paying $800 and then it's never going to change. They mean modified whole life. Modified does not mean that you can change it or it could be changed. It just means it changes once. Write that down. Okay. The next one is adjustable. And again, we spend a little bit of time on adjustable and it's the same thing. It's a combination of term and permanent. And it's the same reason, right? If I have $300 and I'm paying for $300,000 and now I'm paying $150, I'm going to have $150,000 coverage. The caveat to this is in addition to adjusting how much I pay, I adjust the coverage and I also adjust how long it covers me. So it could go from a permanent policy to a term policy because you adjusted that. Now, in the universal life policy, it's so simple, right? It's flexible. So you're like, what? How long do I pay for the policy? Who knows? It doesn't matter. You pay for as long as you want to. That's the way that universal life policies work. I don't know if you noticed the key trend here. Universal life is flexible here, flexible here, flexible here. Just kind of keep that in mind. Okay. Now, the last one is how does the money grow? How does the money grow? And so By the way, if you remember that if you want to make sure that you have this study guide, you could have it nice and pretty in a PDF sent to your inbox. Just make sure that you check the comments below. In the description, we're actually going to have a little link for you to fill out, and we're going to send us this right to your email. I wish, guys, I had this information, this breaking down whenever I was taking my test. I failed that test like 3 times, which gives me the authority, right? Some of us don't teach because we're geniuses. We just teach because we fail so much. Okay. And so if you're going through it, if you're taking your test a couple of times and you're frustrated, that's totally fine. I've been there. I promise you it's totally worth it. Boy, am I grateful that 10 years later, I made the decision to not quit myself whenever I fail my test for the second time. So if that's you, shake it off. I'm hoping this video really helps you out. And if you're looking for mentorship or tutoring, in the comments below, you'll find a link for you to be able to get some tutoring. So just reach out if you need some help. We want to hear your feedback. And we want you to know that you're not alone in this process. So anyway, let's get back into it. So how does the money grow? In the term policy, never. Write this down. Never, ever, never. In a term policy, the money does not grow. So if you at any point see money grows, so will never. Did I say never? Never. Okay, good. So now the next one is in the whole life policy. And the whole life policy, the money grows one of 2 ways. It's either fixed or variable. Okay. And so fixed interest means, hey, we're going to give you 3%. That 3% is going to be 3% forever and ever, forever and ever. Okay. So fixed interest, 3%. Now, variable whole life, which is also a name, by the way, variable whole life, it goes up and down with the stock market. Okay. And a couple of things, I actually have a whole section of my course that says things that mean variable, because you're going to see variable pop up in whole life policies. You're going to see variable pop up in universal life policies, and you're going to see variable pop up in annuities. And so just keep in mind, and I go a lot more into depth like with this on the course, getting value out of this. I really recommend that you pay attention to or consider looking into the course with or without the tutoring. But one of the things that you want to keep in mind with variable is that the only thing that variable is describing is the way that the money grows. And so I tell people variable is so risky in its security. So you need an additional license to sell a variable policy. So you need the life insurance license and you need the securities license, also known as the Series 6, 63, 7, whatever. Again, how does the money grow in a whole life policy? And then in a universal life policy, you have fixed, just like a whole life, and variable, just like in the whole life. And then you have index and universal life, right? Index or equity index. If you see index or equity index, it's the same thing. So now we know what fixed is, which is a fixed interest rate. It's going to be this much, and that is it. We know that variable goes up and down with the stock market. That means when the market goes up, you make money. When the market goes down, there's a floor. When the market goes up again, you make money. And when the market goes down, there's a floor. So one of the things that you want to keep in mind is that when you see index, a question that includes an index will say, Pedro or Peter wants to make sure that they have a policy where there is zero risk, but they want to have the opportunity to have access to growth. And immediately that is not fixed. They are talking about index. Like I said, variable goes up and down in the market. Index means it goes up when the market goes up, but there's a floor whenever there is a market loss. And the last thing that you want to know about index in general, because like variable, is just the way that the money grows. Which, by the way, you're going to see index in an index universal life policy, or you're going to see index in an indexed annuity. And so in an index universal life policy or an indexed annuity, it doesn't matter. There is a guarantee rate of return. Actually, the guarantee rate of return is 0%. And people that are like, Brenda, what are they talking about? 0% being a guarantee rate of return. And I said, well, if the market was negative 20 and you, and as a penny, you only had 0%. Guess what? You technically made 20% on compared to the other people that were in the market that lost 20%. So just something kind of to keep in mind. The last thing that is super important, just to kind of put it all together, bring it, land the airplane, let's call it. So the names of the policies. So you're going to notice a trend that the term policies and a half is going to be a level 10-year term or an increasing 20-year term, a 30-year decreasing term. In term policies, the name term is going to show up always, unless they're talking about credit life. That's the only exception. Okay. But it's going to be level term, increasing term, or decreasing term, or credit life. And you're definitely going to see the amount of years that the coverage expires. Now, when you're talking about, so we'll do this. When they're talking about whole life, right? And I'm going to change my color here. And orange. When they're talking about whole life, in a whole life policy, the biggest bulk of the names of whole life policies is right here. The way that you identify it is, again, are they talking about when does the coverage expire, or are they talking about how long do I pay for this policy? I know that the coverage is forever. So if that's the case, then you'll think about, well, I pay it forever, it's straight life, limited pay. And we already went over that. If you need to review it, you may want to click on the description. We have the little notes. Where you'll be able to go to this particular section. Okay. So whole life policy names are based on how long do I pay it for. Exception is adjustable and then variable life, right? One of the things that you want to keep in mind is that life policies are a little sneaky. Okay. What I mean by sneaky is that so you're not going to see straight whole life. You may just see straight life. So they drop the whole in the whole life name. Okay. Unlike term policies that you will always see term in the name of the policy, in the whole life policy, you may not see whole life. You may just see modified life. Okay. Qualified. So, and then the last one is universal. Okay. And when we're talking about universal, is usually you're going to see the flexible term and stuff like that. But the name of the universal policy is usually based on how the money grows. So you're going to see a universal life on its own. We automatically assume that that is fixed universal life. Okay. Or you will see variable universal life. Or you will see index universal life or equity index universal life. But you will always see universal life. So kind of like term policies will always have term somewhere in there. In universal life policies, you will always see universal in it. All right. Bonus. Okay. Actually, I'm going to give you like a little send off here. And stick around for the bonus at the end. I'm going to tell you how to make the difference between variable whole life and variable universal. So stay tuned for that. So like I said at the beginning, you want to make sure that you watch this video multiple times to help you understand. If you want to have the study guide, make sure like this guide specifically, this little cheat sheet thing, make sure that you in the description below, you're going to be able to see a link that's going to say, download this guide. Okay, so we're going to provide it for you there. So if you want to make sure you have the study guide, make sure that you go to the description below and you can put your information and we'll send that straight to your email. Also in your email, you're going to get a little code that's going to give you access for you to sign up, whether you just want to see more videos like this, organized for your class, or if you even want to do tutoring, we do have tutoring sessions that we do in the morning and in the evening. And so we're excited for that. So going back to the bonus, okay, here is the bonus. If you don't understand the difference, because it's very confusing. It was confusing to me. Variable whole life and the variable universal life. The way that you differentiate it is based on the in the universal life policy. Sometimes you're going to see the cost of mortality and the cost of insurance. If you see anything connected to the cost of, immediately you're going to know that that's going to be universal. The second trick is understanding the difference between flexible universal and flexible whole life policy. A flexible whole life policy that doesn't exist. Fixed whole life policy. So if the premium premium is fixed, then you know they're talking about whole life. If they're talking about flexibility, then you know it's universal. So that's the main thing that you're going to see. And if they're very specific as to how long you're going to be paying it, immediately you're going to know that this is going to be a whole life related question and not necessarily a universal. So how would I use this little square? Question, they say, well, Peter wants to make sure that they cover their children, right, while they're still small. Then you know that children are only going to be small for X amount of time, let's say 20 years. So you know that the coverage is going to expire. So they're talking about expiring coverage. You immediately are going to drop off for universal. You'll be like, okay, so talking about term policy. And then based on the second clue of the description, you'll figure out whether it's a level, increasing, or decreasing term. Okay. Now, if they're talking about, oh, these guys really want to make sure that they have cash value, you immediately get rid of, you guessed it, term, because term never ever has cash value. Okay. You go between whole life and universal, and then you figure out whether the premium is flexed or flexible, whether they're talking about flexibility in the face amount, whether they're talking about how long is being paid and stuff like that. So I hope that this information is helpful to you and to be able to navigate through this little square for you to pass your test. My recommendation, watch this video a couple of times. I know I said it a couple of times, but it is that important. And the last one is do this little square on your own as well. Do it, commit it to memory. I'm somebody that doesn't necessarily remember things, but if I write it, I have a better time remembering it. So a lot of information, like I promised you, in 30 minutes. You want to make sure that you practice this a couple of times and that you spend time with it. Because like I said at the beginning, I'll tell you again, this is 30 to 40% of the question. By the way, if you made it till the end of this video, I want to thank you from the bottom of my heart. We're super excited to be able to launch and to walk through this journey with you. I cannot wait to read your comments and see what other concepts you want to learn, understand, and you want to maximize. Let us know in the comments so that we have the opportunity to create content that helps you get better and be profitable in the life insurance industry. That being said, I cannot wait to meet you, to know your story, understand where you're at, but also where we're going. Till next time. Ciao, ciao.